for our next keynote of the morning. That is InsurTech. When things go wrong, it's important to look at both sides, isn't it? My guests are Rupert, Vice President at Marsh, and Alex Phillips, Senior Vice President at Marsh. Hi to both of you. How are you?
Very well, thank you. Thank you so much for having us.
You are very
great. Thanks for having us.
Yeah, you're very welcome indeed. We are running slightly behind time, so I won't take up any of yours. So the virtual floor is yours, gents.
Oh, thanks so much. So we at Marsh, we're really thrilled to be here. I really think for myself, I've worked in insurance for over 20 years, and I could definitely tell you that it needs a shake-up and it needs the new sort of that InsurTech is bringing. And we really want to support the InsurTech industry, whether that be what we're going to talk about today in protecting your business and making sure that you can grow in the right ways. It might be finding capacity, it might be supporting employees, but we really want to support you. And the purpose of this call is not to scare you or something like that, but just show you what can go wrong and how we're going to protect you. So Rupert, if you want to give.
Yes, so work very closely with Alex here at Marsh, and we're really excited to speak to you today. Have slightly less years experience than Alex, but had a brilliant opportunity to kind of get involved with lots of fintechs, some of the largest fintechs globally, provide some innovative solutions. It's a really interesting space and it's fast moving. And there aren't necessarily the solutions out there previously 5-10 years ago. So it's an exciting space to come in and hopefully make a difference to some InsurTechs around the world.
Okay, so go to our slide. So at Marsh, we deal with a lot of insurance companies. We deal with 13 out of the top 15 P&C insurers. We deal with 11 out of the top 15 life insurance companies. This data gives us really great insights for you. And what this is recording is every single notification we get under a crime policy, which is fairly obvious is for a crime against them, a cyber policy, cyber type attack, a D&O policy, where there would actually be a claim against the individual directors, or an E&O or PI, as we call it in the UK, so a claim against you for your professional services. Now, in the top left, we look at the number of notifications a year, and you'll see that mainly the claims are under the sort of PI or the D&O policies. And looking in the kind of top right part, you can see, again, the vast majority are either going to be civil claims or coming from the regulator. Now, that is really paved through by the actual claimant type in the bottom left. So 41% of the claims an insurance company will receive is directly from its customers, and another 16%, or just under 17%, are from the regulators. So I'm just going to give you some examples of that. So what we'll see, for example, on the standard customer claim, and normal insurance, the P&C insurance company would focus a lot on bad faith claims in the US. So standard like $25 million, we've seen claims where there's extra contractual obligations or it goes over the limit they may have purchased, but punitive damages in the US is a big issue. We'll sometimes see where there's a crossover between the regulatory body and the customer. So, for example, life insurance companies have been looked at very closely by the regulator in terms of their mis-selling. And then after that, following that investigation, that's mean a full customer redress. And we've seen claims in excess of 150 million in terms of returning premiums and loss of income that the individuals would have received. On the pure regulatory side, whilst the insurances can't cover fines, the cost of actually defending these kind of actions is very high. So even just looking after, say, like a Lloyd's syndicate, it's not obviously a publicly listed big company, they've had sort of FCA and SEC investigations into them, and the claims can be well in the sort of 8 to 10 million mark just for purely defending the directors from those allegations. And then also, we're going to talk about this a little bit later, but in terms of fraud risk and cyber fraud as well, specifically, because of the involvement of the payment of claims payments to third parties, then InsurTechs and insurance companies can be definitely something that's criminal gangs will seek to look after. So we've seen big payments for claims go to criminals rather than to the actual policyholders themselves. So that's definitely happened in the past before. This bottom right-hand graphic here will show we're predominantly dealing with policies that are placed in the UK, this particular call. But as you can see, whilst you may be a UK-based insurer, you will want to start branching out and offer your services in other countries. Now, it is not a great surprise to see North America, for example, as a big hub for claims. The other one I was just going to highlight here, because the class action structure there, is Australia, because the threshold for launching a class action is much lower than even it is in the US. And we've seen some very big claims for insurance companies where they're white labelling products and have been given enhanced commission to the seller of that, the distributor. And at that point, there is an argument as to whether there's actually sort of validity in the insurance product. So pricing is an issue in that space, and class actions big. So that's why we'll see quite a lot of claims in Australia. Rupert, I think we're ready for the next slide.
Perfect. So now we're going to discuss 5 areas to consider where the risks might be slightly different from InsurTech's compared to the incumbent insurers. One of these areas is reliance on third-party risk. We live in an interconnected world, and everyone has to rely on third parties to varying degrees, and InsurTechs and incumbent insurers are no different. We do see the risk manifest itself slightly different with InsurTech compared to the long-standing incumbent players. Typically, an InsurTech, especially when they're starting off, will partner with an insurer who will be providing the capacity for the InsurTech's products. This is a great way to quickly gain market traction and kind of reduces some of the setup costs. It works well for InsurTechs because lots of InsurTechs operate with commoditized products where there's standardized pricing. So you can agree on a pricing matrix with an insurer and stick within those realms, and it all works perfectly. But what happens if there's an algorithmic error and the InsurTech accidentally strays from this pricing model? You can incur liability, but also more importantly, you might tarnish the partnership with your insurance provider and not be able to provide services going forward. Distribution is obviously changing hugely in the insurance market. In spite of the protestations of some of the old guard we see around the City of London, pen, paper, stamps is probably not going to return. InsurTechs are at the forefront of this innovation in the way they distribute products. And a great way that they're doing this is via third parties. So, for example, online merchandisers, airline providers. But an issue with this is that there is an element of loss of control where you're relying on the third party. For example, if an airline provider's description of an InsurTech's product doesn't quite match up to the product itself, so for example, it's done some white labeling and then created some marketing off the back of it, and then there's a claim from the policyholder which falls within the gap, there could be a huge reputational issue here, and potentially some legal costs, investigations, fines, penalties, etc. And in terms of moving on, I'm going to pass it back to AP to talk about regulatory change.
Thanks. In terms of regulatory change, I mean, I think I have a lot of sympathy with insurance companies and general InsurTechs because you've got effectively 2 regulators. You've got the Financial Conduct Authority in the UK, or a sort of consumer-based regulator, and then you also have a prudential PRA in the UK, but similarly in every other jurisdiction that is actually looking at the balance sheet and the longevity of the business. And sometimes managing those 2 is incredibly difficult and challenging. What we see, though, is, for example, areas of interest for you would be licensing agreements. So as you look to expand globally, there are different jurisdictions who have different licensing requirements and different licensing requirements for different products within that, whether it be especially in the sort of personal line space and auto and home. We'll also see areas of data privacy, such as GDPR, you've seen, and also Rupert's going to talk a little bit to this in AI later. There'll also be the consumer protection aspect. So, for example, over in the UK, we've now got the consumer duty regulations coming in, which do raise the bar for the advice and also the sort of value of that product and demonstrating that, which is definitely in insurance. And the other one that I mentioned with this sort of PRA hat on is the actual capital requirements for insurance companies. It's a huge issue. We've seen, for example, in the banking industry, you only need to look at that. Metro Bank earlier, 2 weeks ago, had issues around their liquidity and sort of regulatory capital that they needed to capital raise. SVB Bank went bust, but it would come with insurance companies as well, as we'll come on to a little bit in the fraud section. But also changes possibly in the UK were talked about for Solvency II. Regulations could change some of that. So I'll hand it over to Rupert on AI.
Perfect. So AI, obviously, it's the buzzword at the moment. There's an unwritten rule that you have to include it in every presentation, so we thought we'd oblige. It is really pertinent for InsurTechs and insurance companies, especially when you look at the risk landscape. AI has been a fantastic tool for InsurTechs to be innovative, to reduce costs, which is ultimately only going to help their customers, bringing cost of products down, especially in the tough times that we're currently living in. But there are some risks when we use AI. InsurTechs have used AI quite a lot in coding when developing new products to stay on top of the curve, especially when you've got some shareholder pressure to continue to grow. The use of AI enables you to write code at a quicker rate than without it, and there are a few useful tools. There are, however, some issues with this. AI is obviously going and using and harvesting coding from other areas. And we've seen a couple of IP issues where the AI tools have actually taken intellectual property, i.e. the code, from other companies in writing out products, which is obviously an issue which InsurTechs need to be aware of. AI has been a fantastic tool, like I mentioned, but there are times where it appears to be biased. In particular, machine learning has made some erroneous assumptions, which has led to prejudice bias. And if we look at the way InsurTechs using AI, it's been done very cleverly around claims and pricing. And if that's done incorrectly or there's bias, which is integrated into the offering, we could potentially be discriminating using certain characteristics which we just wouldn't look to do in 2023. So that's really an area where InsurTechs, again, I think would pay dividends to remain vigilant on. And in terms of remaining vigilant, I'm going to pass it back to AP for fraud.
Yeah. So fraud, we've seen not just in InsurTechs, but in fintechs in general. Fraud's probably the number one difference between what we've seen in the traditional space to what we've seen in fintech and InsurTech is that there's seems to be a much larger risk. The thing is, you only need a vulnerability in a system for a number of hours, and suddenly the claims can run away with themselves. So seemingly 4 hours can, for some companies, make a sort of difference of about $20 million. It's been that stark. So there's things in InsurTech that I think are really worth highlighting. So we actually at Marsh, we definitely support this, but the idea in InsurTech bringing forward, especially with parametric insurance and things like that, is the speed of payments. It's something, our largest clients are most interested about is actually how quickly from making the claim to actually getting paid there is. And I think InsurTech is doing an amazing job in this, but there are obviously unforeseen errors that can happen if you're trying to make very fast claims decisions, that you are not being defrauded and paying for false claims. And especially as Rupert was earlier speaking to, if you're using third-party capacity to provide those claim payments and you're doing it too quickly and incorrectly and being defrauded, there is going to be an argument as to who's liable for that. I do also think that something that we'll obviously touch on for many years now, but in anti-money laundering regulations, we are now starting to see much more sort of sophisticated criminal activity around deep fakes and identity theft, and being able to sort of set up policies and obviously cancel policies. Insurance companies have always been a big target for money laundering through claims payments or cancelling policies and return premiums coming through. But I think with the new sort of the sophistication, quite frankly, of these companies, these criminal gangs, then we will only see an increase in that. And the other one is just in terms of sort of capital requirements. There's obviously been a very large case recently with another InsurTech where they've been relying for their reinsurance requirements on letters of credit provided by a third-party bank, making representations on the back of that. It's turned out that those letters of credit were falsified and that the InsurTech had not fully, sort of, allegedly checked those or verified those letters of credit. Now, that obviously is a dreadful problem for that reinsurer, but it's also, as you might have seen, it's now leading to claims directly against the CEO, CFO, the management, as well as the reputation. And these things can bring the sort of consumer trust down in an InsurTech almost overnight. So it's really something to work towards to protecting. And on that note, I'll hand over to Rupert on cybersecurity.
And cybersecurity is an area where InsurTechs should hopefully blow the incumbent insurers out of the water in terms of sophistication. Apologies for like colourful language there, but where we see huge differentiation is board representation. 10, 15 years ago, when insurance companies were told to bring someone techie onto the board, some insurers were slightly reluctant to do so. They didn't want to open the doors, didn't want to invite others into the party. If obviously this is in stark contrast to some of the largest fintechs and insurtechs that we see, where 50% of the board are represented by tech guys and 50% non-tech guys. And this is a huge advantage, especially when your business is financial and technology based, hence in the name. Additionally, when we look at kind of incumbent insurers, you've got lots of legacy systems, and those which have acquired other companies have legacy systems which tape together and it doesn't quite work as it should do. And then you look across the road to the new guys on the block, the InsurTechs. They've got these shiny new systems with the latest privileged account management systems, endpoint detection responses, and they've got lots of tricks up their sleeves to prevent people accessing their systems. So that's one area we really see InsurTechs excelling in. However, on the subject of data, InsurTechs have been fantastic about streamlining claims processes, putting the London market slightly to shame in certain instances where we have long tail risk and potentially claims taking years and years and years to settle, and being able to, and InsurTechs being able to pay out in a few minutes in certain instances. But this has been heavily reliant on biometric data. And as AP mentioned earlier, the regulatory landscape is an ever evolving one, and it changes depending on the jurisdiction you're operating in. So we are really encouraging our InsurTech clients to remain on the ball and making sure they're compliant in all territories, as we think this might be an emerging risk. We've already seen some litigation in this space. And that brings us to the end of the presentation. So thanks a lot for taking the time to listen to us. Now it would be great to welcome any questions. Of course.
Thank you very much indeed. And yes, we do have a time for a couple of quick questions. For you, both of you, whoever wants to field this, go ahead. Where do you really see InsurTech's landscape evolving over the next few years? Do you feel it's really going to permeate that board level and become less of a bolt-on, less of a place we're going, but as an essential part of the furniture?
Yeah, I'll take that. I totally see that it's going to become an essential part of the furniture. So to give a really good example, in the London market right now, there's something called the Key Syndicate, which is an algorithmic syndicate that's come into the market. It's a subsidiary of Brit, and they've done an amazing job setting that up. It's the fastest growing syndicate. It's got the best loss record of any startup syndicate, and it's using machine learning and is also, apart from being like that, it's also very easy for brokers to interact with. So something like that is now becoming quite key in the market, and we just see a continuation of that from many others.
And my final question is, you've done a great deal of research and got a great deal of insight into the sources and causes of financial losses for InsurTechs. Was there one thing that you'd want to surface that really surprised you or shocked you at all?
I think it's probably the fraud. We've really seen that come across, but that's probably the biggest change between a traditional insurance company and the InsurTechs is around fraud.
It wasn't really a shock, but I think the cyber abilities and capabilities of an InsurTech are just so much further advanced compared to an incumbent insurer. So I think that's one huge area which hasn't necessarily been a surprise, but there is a huge contrast.
Yeah, really emphasise the difference. Rupert, Alex, thank you so much for joining us here at InsurTech Live. Really enjoyed your presentation and your insights and thoughts. It's been fascinating. Thank you.
Thank you. Thank you all.
Thank you.